Good morning and welcome to the PARITY Group PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the top right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish those responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand over to Mark Braund, Chairman from PARITY Group. Good morning.
Thank you, Zach, and good morning to everybody. Welcome to our results presentation. I'll go on to the first slide, if I may, obviously through the disclaimer. Hopefully you've all received and hopefully read certainly the front cover of our annual report. Effectively, what we've seen is this has been a year of two halves that we're reporting on. The first half of the year was the coming to an end, frankly, of a management team that was pursuing a strategy that they pursued for 3 years prior that basically failed to ignite around building a consulting business, and had been the beneficiaries of a long-standing, strong brand in recruitment, generating pretty much all of the revenue, about 47 million of revenue. And that was basically keeping the business afloat. However, the business had been neglected, and the recruitment part of the business, which had been so long for the last 45 years, actually, the key part of the brand had been pushed to the back, was underinvested, and the business was declining as a result. It was somewhat disguised, though, because PARITY is one of the most recognizable businesses in the public sector market, providing skills and talent into that space. And during the pandemic, that market was actually relatively stable. Government typically did not want to be putting their own workforce out of work, nor the contractors that supported them. And also the government was engaging quite a lot of digital development, which suits our environment and certainly the skill sets that we work with. So the business pretty much carried on trading. But what that management team had recognized is that it didn't really need much help. So unfortunately, they not only underinvested, they took a lot of cost out. And as a result, for the first half of the year in question, we probably ended up with only about 3 people, 3 people, effectively managing the customers that were generating that 47 million of revenue, and the sort of 400 or 500 contractors that were supporting that revenue as well. And that was fine whilst we were in the middle of a pandemic with nothing changing. As we came out of the pandemic, obviously demand, as most people will know, accelerated. And the company was in no position to take advantage of that. Instead, it continued to see its revenues decline as strong, talented contractors were attracted to other contracts elsewhere. And we just didn't have the resources to apply ourselves to that to stop the decline. And that's what brought about the change. In the middle of the year, June 27th, I think we announced the fact that the management team had been changed. And what we've done since is to refocus the business back into its roots, into its recruitment roots. We should not underestimate the power of the brand. Regardless of how small the company is now, we still have a very influential brand. The quality of the business is still actually well respected. And what we've done with the team is we've developed the team and rebuilt it. We started off by eliminating the top-heavy management structure. We had 7 or 8 executives at that time. We now have 2.5 or 3. There is Mike, who you can see on screen. I'll be introducing you to in a second, the CFO. And Isabel Brown, Izzy for short. Izzy is the person that leads our commercial and operational business. She's a powerhouse in the business, and hopefully we'll be able to introduce you to her next time we present. And Mike runs everything else: finance, operational processes, and infrastructure and corporate services. So really, we're now a very streamlined simpler business. The buck stops with us, and we're all devoted now to one mission, and that is to reposition the business as a very strong talent acquisition partner for our customers in a market that is booming. Izzy has rebuilt that team. We've gone from 3 to well over 23, 24, 25, in fact, I think. And the team is well placed. We've set up an academy run by Kirsty Dallas, who Izzy has developed into that role, and she's developed her second batch now of newbies. We call them quite affectionately newbies. These are people that may or may not have been in the recruitment industry before, but haven't really found their way yet. And we've got our own way. Izzy has the new Parity way, and we've developed 6 people, 2 batches of 3, 1 on contract and 3 on contract and 3 on permanent recruitment, and they have all hit the ground running, and they're all very productive already. Within a space of a few months of having started with the company, so that academy process has been, I think, very successful for us. Albeit, we've only run through 6 new hires with that process so far. It shows what we can do as we develop scale. With the team that Izzy's built, they set to work on basically stopping the rot, effectively establishing strong customer engagement processes with our existing customers, and a strong contractor engagement process. We have 2 customers, effectively. We have those that pay the bill and those that we pay. They both are viewed as customers, and we have to look after them and treat them with the right level of reverence in terms of making certain that we can deliver value to both of them. And we can't do that without people. Izzy's built a team that actually does that. We've got the right processes, got a fantastic compliance process, which is quite important in our space. And with that, we've had some fairly strong early results. We have, out of our top 5 customers, materially grown the revenues with 3 of them. In fact, one of them we've actually doubled, and I mean materially increased to double. These weren't small customers. And with another 2 customers, we've actually got exclusive arrangements where these customers in the past have worked with several agencies, and now they're just working with Parity. So we've got the signs of success. However, I want to make it clear that we've been catching a falling knife. The revenue has been in decline in the recruitment business through neglect for 2 or 3 years. And certainly for the last year, and we have slowed down the decline to pretty much a stop, and we've hit the sort of knee of the curve, and now we're starting to think, how do we actually begin to regrow back up again? So that's been the picture throughout the year. So when you look at the numbers, you might look at sequentially things that are getting worse, but actually they're now starting to go back up the other way. So we've materially improved customer engagement. We've got very strong customer sat, and all this has happened in a relatively short space of time, 6 to 8 months. And we are rapidly increasing the share of wallet we have with the customers that we're engaged with. So I think the key message is that we're no longer pursuing other avenues. This company has had a few failures on its hands by trying to be something that it's not over the last sort of 10 or 15 years. We're going back to our roots which actually created a well-known brand, and one that I think can be very successful in a buoyant market going forward. So Parity is now focused on growing as a recruitment business. If we can just go to the next slide, please. So having the team, Mike and Izzy basically rebuilt the business. And one thing I did forget to mention from the previous slide is that Mike and his team have actually worked tirelessly on refining and simplifying all the back office processes. We now have a very, very flexible, very streamlined and very productive back office. It's an area within recruitment that you can be overburdened, and an overhead that becomes a fixed overhead becomes a challenge. we have now got a very flexible overhead, and it's very scalable. We could shrink it further if we needed to, and hopefully we don't. But we can also expand quite rapidly without building further fixed overhead going forward. So we've done a fantastic job getting the infrastructure of the business in good shape as well. So we're actually in a very good sort of fighting fit state, but we've got an awful lot of work to do. So what are we doing about new opportunities? Well, obviously, having come off the back of a series of losses and restructured. I mean, the business was restructured 3 years ago, and here we are. We haven't restructured, but we just refined. We think it's important now to give everybody confidence that we know what we're doing, that we can actually not just hold on to the business we've got, but begin to grow it. But we've got to do that in a refined way. We don't want to go splashing the cash. We actually want to do it in a steady approach. So what are the areas that we're looking at the moment? This is still evolving. The first area is that we've established over the last 6 to 8 months that a key area that we have a strength in, we have a strength in depth actually in terms of connection to a network of talent, not just here in the UK, but also in Europe, of solutions architects. And solutions architects have become very much a hot property, a very high demand environment. And that's driven predominantly by the fact that our economies and even the public sector is moving faster to digital and faster to the cloud. And core of that, you need strong solutions architect to help the business move forward. We have a good network of talent. We have the recruitment capability and the talent managers to be able to help our customers find that talent, and also the talent that's out there find the best projects. And that's an area where we're going to focus, and it's an area where high demand and short supply means that we can improve margins. So that's one area where we're focusing our growth intentions on. The second is permanent recruitment. You heard me mention a second ago that Izzy and Kirsty had put a team of 3 people through an academy to focus on perm. We'd also hired a very strong permanent recruitment professional and manager to lead that team, David, and they've started to be productive. Now, why is that news? It's news because Parity has never really done permanent recruitment, and the market is very strong for permanent recruitment right now. Contract is a valuable business; it's recurring revenue. But some of the key roles out there, customers actually want to hire directly, and solutions architect, with them being so key, that's a talent that we believe there's great value in us pursuing. So that team is focused on solutions architects and 1 or 2 other key roles, and it's already had a good start to the year. We brought David in towards the beginning of the year, and the academy generated the talent that's come through that a couple of months ago, and they've already made placements, and these placements are at 100% gross profit. Permanent placement has no cost of sale or cost of goods, and it's an area where we believe we can provide ourselves with some margin enhancement, as well as providing a valuable service to both our customer sets, both the customers that employ them and the customers we have that are our contractors and candidates. A third area, so I've talked about solutions architect, I've talked about perm. A third area that we see as a potential for us to develop is what we call the embedded recruitment function. It's interesting that during the pandemic, a lot of organizations, especially the large ones, shrank their HR communities and certainly their talent acquisition teams. And then as the growth came back into the market for hiring, they were left wanting. Now, one way to resolve that problem is to use agencies like ourselves. Another way is actually to hire more staff, but you don't know when the next challenge is going to come. So the third way, which is a way that we're beginning to see some traction for, is actually for us to put one of our specialist recruiters with all the tools that we have and the access that we have into their organization as an embedded resource to effectively be to go native, to be that customer and help them through the peaks and troughs of their recruitment needs. And as I say, that's an area that we see has some real potential, and we're at the start of beginning to explore that now. I think the final thing to say on this slide is really that with the academy and with a really new sense of a new beginning and a strong brand, we think we've got, or we believe we've got, the makings of a really important opportunity here for the company and for the people that work here. So we've got the capacity to grow. We just now need to demonstrate that we can do so, and we're treading very carefully. So don't expect dramatic growth overnight, because we don't believe we should at this stage use the company's funds to make big investment decisions just yet. We want to make them in a measured way, demonstrate that we can get success, and then get behind them. So far, so good. We are beginning to see some early signs of success, but I would expect you to see some of those signs for the second half of the year rather than the first half of the year. So with that, I'm going to pass you to Mike to take you through more of the detail on the business itself over the last 12 months.
Morning, everybody. Hopefully you can see this. I'm going to take you through and give you a little bit of insight into some of the numbers, some of the key numbers that we've got. Revenue, first of all, as Mark said, we saw a decline in contract recruitment during the year, and so revenue has fallen from 58 million to 47 million. Key for us as a measure, rather than revenue, we will use net fee income. We have a high degree of cost of sales because we're a contract recruitment business, so we pay our contractors out. So net fee income is a better measure for us of the income coming into the business. That has fallen from 5.6 to 4.1, and I'll talk you through some of the reasons behind that. We made an adjusted EBITDA, a small adjusted EBITDA profit of 0.1 million for 2021, reflecting how we've managed the costs with the declining revenue, but also been able to make some investments within that. And then the other key areas that I'd like to point out and that I'll talk through are that we have moved from a net cash position to a net debt position, and not unexpected in doing so with the changes in the business and the fact that we've needed to make some changes, and therefore there are some non-underlying costs. And some good news within here are defined benefit pension scheme has increased in surplus, and I'll talk you through the background behind that. So moving on to the next slide, talking about net fee income first of all. As I mentioned before, that's gone down from 5.6 to 4.1, and there's two primary factors behind that. The first one, as Mark explained earlier, for a long time the business has suffered from investment moving away from recruitment and into other areas in pursuing the strategy around data consultancy. And so therefore the recruitment pot has been left somewhat bare and unable to manage both the clients and the contractors effectively. And during 2020, there was a lack of movement within both contractors and clients as everybody hunkered down due to the pandemic. During 2021, as we've seen an increase in confidence, we've seen a lot of contractors who would have normally rotated and moved between contracts more regularly that have stayed put during the pandemic. We've seen a higher instance of them moving. And with limited resource in the first half, we saw higher levels of contractor attrition as contractors chose to move to new projects, and we didn't have enough resource to either identify the fact they wanted to move or to place them into those new projects. And so that had a significant impact. The other side of it, there's natural levels of attrition as contractors move off projects, and normally that would be replaced by new business coming in and us being able to take on new clients. With limited resource, our ability to capture that new business as the market started to improve has been incredibly limited. And so therefore we've had more contractors leaving than we've had contractors coming in. The other element and primary factor around the loss of net fee income was the failure to ignite on the data consultancy, which has meant that we've had a drop against the prior year on the consultancy as the switch in the consultancy focus hasn't delivered the results that were expected. There were early signs at the beginning of the year, but an inconsistent pipeline meant that actually that wasn't sustainable. So what we've seen is that contract recruitment has fallen from 4.6 million to 3.4 million net fee income. Primary drivers for that, 1.1 million of lower contractor numbers, which has been offset partly by a small increase in billing rate, but there has been a drop in margin. So the change in billing rate has come around for two reasons. One is that we have, as a business, focused on higher value contractors. And so therefore, the billing rates for those contractors has gone up. So we focused on higher skilled IT professionals, and that has increased our billing rate. A small factor in that as well is the IR35. So the government ensuring that taxes are paid correctly by contractors. We've had increased compliance being applied to the private sector, and that has meant that more employment taxes has been pushed into the rates so that contractors aren't paying employment taxes effectively, and that's pushed the rates up slightly. Margin has fallen slightly as a percentage. That has fallen because with the lack of resource, we focused the resources that we have had on key clients and growing key clients, as Mark has said. The downside to the key clients is that they're often slightly lower on margin, higher volume, but slightly slower on margin as a percentage. And so that has an impact. Outside of contract recruitment, we've seen non-contract recruitment, so the managed service and consultancy side, fall from 1 million to 0.7 million. As I said, that's primarily down to the fact that the strategy around data consultancy didn't have enough legs to deliver, and ultimately we've now chosen to move away from that and move back towards pure recruitment. As I said earlier, we've made a small Ebitda profit in the year, and we've done that through our ability to manage our cost base. And that has been despite the fact that we've made significant changes within the business during 2021. So what we've done is we've reorganized the business. Mark has said we've changed the management team. The management team was focused on many opportunities outside recruitment. What we've done is focus it back into that. So we've been able to recover cost by reducing the management overhead. We've also taken costs out from operational roles that were focused around consultancy and put them into recruitment. And we've had some small reductions in costs in other areas, including our premises overhead, etc. What that's done is created a capacity for us to invest. So overall, we've saved 1.1 million in terms of annualized cost savings. Now that's not all going to fall to the bottom line, because we've done that so that we can invest back into the business, specifically around recruitment. So of that 1.1, 500,000 of that has come through into last year, FY21. And the rest of it will then follow through into this current year. Now, within that 500,000 that we've saved, we then reinvested 300,000 back into the business in terms of new roles within recruitment. We've also had the benefit of the transformation program that was going on for a couple of years in terms of reducing the back office, streamlining it, improving systems, etc. There's a residual cost reduction there that's fallen through into the year of 200,000. So that's allowed us overall to save 400,000 on our costs, which has offset a lot of the fall in the net income, and allowed, despite EBITDA falling, we've been able to maintain a positive EBITDA. The recruitment or the increase in the core recruitment business has enabled us to add more client-focused people. And that means that we can work with our clients and with our contractors, ensuring that we can manage contractor attrition, and we can also invest in new business growth as well. And that's all been done whilst during the year we've reduced our operating costs by 10%. So that's the key driver for us maintaining EBITDA and giving us capacity to grow. And also for the coming year, for the year that we're now in, 2022, we've got capacity then to add more heads, which, as Mark's described, we have done with building a perm team and adding further to the recruitment business to drive new business. So as you would expect, with all the change that's going on, that change has resulted in some cash outflows, and we had a small positive as we went into 2021 of 200,000. So we've moved into a position where we have at the end of the year net debt of 1.2 million. We have in place a working capital facility that we utilise and that we're able to manage very well within. And we signed a new 3-year deal with Lumi in April 2021. So that runs through for a further 2 years from where we are now. That gives us the capacity then to manage both the payments that we need to make out to contractors ahead of getting money from clients, our normal working capital, but also to soak up and allow us to make some of the changes that we've made. our operating cash outflows in the year of the fall of 1.4 million were only 300,000, and that includes our investment in some management information systems during the year as well. So the majority of the cash outflows were non-operating, and that included the changes that we made and associated costs of changing management and changing some of the people out. That also includes the cost of the pension contributions that we have to make to our defined pension and the costs of financing. So those, and the other piece that I forgot to mention was during COVID, the only thing that we did in terms of as a business taking support from the government was to defer our VAT payments. And so as we've now paid that back, that's had an impact of 300,000 coming out in terms of cash during the year. So our non-operating cash flows for the year amount to the majority of the reason for the change from a net cash position to a net debt position. As I mentioned at the start, we have some continuing good news with the defined benefit pension scheme. This is a scheme that's been in place for decades and hasn't taken new members on since the 90s, but it's something that as a business, and a business with such a long heritage, we need to continue to fund. There's circa 67 members within that, and what's been happening over the last few years is an investment program in terms of the assets, and very, very tightly managed so that we can increase the value, so that we can get ourselves to a position of surplus. And ultimately the goal is to get it into a position where there is an opportunity to sell that pension scheme to an insurance business and then remove the liabilities for continuing to pay the pension, from the business. So over the last 3 years, we've seen strong investment performance. And over the last year, what we've seen is we've switched out some of that investment strategy so that it is more closely linked to the liabilities, locking in a lot of that surplus amount. Now, we've seen the pension assets fall slightly, but we've paid out during the year circa £1 million in benefits paid to the members as well. What you've also seen during the year, because of a change in discount rates and a small fall in the number of members, the liabilities have come down. And so we end up with an increasing surplus now. And that surplus we would expect to continue to grow and to get to the point where it becomes an opportunity for us to buy out, or for an insurer to buy that pension scheme out and for us to take it off our balance sheet. And that's a few years away, but we continue to work towards that. And that will then free up. At the moment, we pay circa £300,000 a year in contributions in cash that's going out, that's non-operating. And once the pension scheme is gone, we can then free up that cash flow for further investment. So that's the key financials. Just really want to summarise, the presentation so far. We've refined the strategy for Parity. Parity has a strong heritage and strong brand, particularly in the public sector, and that is primarily around recruitment, and that's where we've focused and refocused the business. And we've been able to do that during the half year, during the second half, and got ourselves into a position now where we can take the business forward. We've got a strong operating team able to convert opportunities. We've got a market now that continues to expand, and that we've now started to build our new business. And with the ability to then convert that, we think we've got a very, very bright future. One of the things we want to do is, and we need to do, is to get on with the journey, to continue to build on what we've done, to continue to build new business, to continue to do what we said we would do and rebuild back the investor confidence. And our aim, obviously, is to return Parity to growth and profitability. And we're seeking to do that organically. And once we've been able to develop that, we'll look at other opportunities as well. But at the moment, we're focused on doing what we say we're going to do, which is now building back new business capability and starting to re-establish growth and to build on the profitability of the business. With that, I'll end and I'll pass back to Zach.
Yep. Well, it's to me, Mike. We got some Q&A to cover.
Okay.
So
right.
yeah, I'll coordinate the Q&A with us both, if you don't mind.
Mark.
Yes, Jack.
Mike, thank you very much for your presentation today. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. But just while the company take a few minutes to view those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Mark, as you can see, we received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. Can I please ask that you read out the question and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Certainly, thank you, Zach. So the first one on here is from Jacqueline. Mike, I think you know who Jacqueline is.
Yes.
And she doesn't appear to have a copy of the annual account, so we'll make sure that comes to you today.
Well, the annual accounts themselves aren't yet fully published. They'll be done alongside the AGM, but the results are released as part of the RNS. So,
of course.
All of the key numbers are within the RNS. Yeah,
fine. Can we also just pop a copy on email to Jacqueline as well? Perfect. The next one is from Mark A. The question says, are the key changes to the business now complete, and how should the success of these changes be measured? Mike, do you want to have a go at that one first, and then I'll come over the top of it?
Yeah, sure. So yes, the key changes are complete. As we've said, we've refocused now around recruitment. What we're now doing is further investment now in new business, which we will do in a phased approach. So we want to see success of what we're doing with both permanent and contract. So it is now about building further. And how should success be measured? Well, I think that it's around new clients, new contractors, and growth in our perm over the year. As I said, we're looking to see the second half of the year. Once we've established the teams and they've started to make initial success, we'd expect to see the second half of the year as being a key area where we'll see those changes happen, and that we maintain the conversion rates that we have with the team. We've got a very, very strong operating team converting, and the opportunities that we have into jobs, both permanent and contract, and we want to maintain and continue to improve on that. Mark, do you want to add something?
Yeah, no, I think you pretty much covered it. I think the only other thing I would mention is, whilst our mind, as you can tell, our mind is very much focused on now how do we grow, we shouldn't forget where we come from, and that is, the last 8 months or so has been, tirelessly focused on re-establishing the links with our key customers and building out, well-structured and well-delivered programs of value for them, and that's been done very well. So I would just say to you, the other key measures now are share of spend with those customers and customer sat. It's not a cliche, we've got to deliver the best service to our customers for them to want to work with us ahead of anybody else, and that's what I know Izzy and her team are focused on. They have fun doing it. It's not a chore. It's something they really enjoy doing, and the customer sat so far appears to be very, very promising. So that's the other key measure, I think, will be customer satisfaction or net promoter score, whichever one we decide, or maybe we do both. But that answers that question, I hope, Mark A. Mark A has asked a follow-on question, which again I think both of us may have a comment on, Mike. It's post changes. What is the size of Parity now compared with before, and how much of an impact will this have on your ability to drive revenue?
Okay, so I think Parity is significantly smaller than it has been over the years. So several years ago, we were turning over more than 90 million. We're now significantly lower than that, but we are now focused on recruitment. I think in terms of our ability to what impact it will have on us, we have, as part of the changes we've made, freed up opportunity to invest in new business. But given all the changes that have taken place, we will take that slowly. So we have the opportunity to invest and to grow, but we don't have unlimited funds to invest. So we will invest, we will succeed, and then we will invest further on that. So we will see growth, but we won't be able to just throw a lot of money at the market. So what we want to see is sustainable growth.
Yeah, Yeah, I can't add anything to that. I think it's a great answer, Mike. Thank you. So moving on to Michael D. It says, who are your major competitors and what do you believe differentiates Parity from them in attracting and retaining new clients? I think when we answer this one, Mike, we need to look at how we're now looking at our business. You know, so you've got the sort of mainstream heritage of the business, very strong in public sector. And I think that our competitors in there, I mean, you correct me if I'm wrong. Let me have a go at answering this one first. Our competitors in there are numerous, but I think we're one of the strongest. You know, you might see companies like Capita and Harvey Nash as sort of mainstream names, but there are others in that environment. But one of the value adds that we have that is taken very seriously in government, Mike touched upon, and that is quality and compliance. It's become a very serious topic, and smaller companies are finding it very difficult to actually apply the right processes in that environment, and therefore companies like Parity are actually considered to be not just a good quality house, but a safe house as well. And I think that in itself is something that we are seeing delivering extra revenues to us. So I think that in that space, you know, we have got competitors, but I think that in the area that we're addressing, you know, we're amongst one of the strongest, and obviously going from strength to strength. Now we've rebuilt the team. I think outside of that, when we start to look at the private sector, it's a market that has got 22,000 companies all trying to vie for attention in that space. And you might say, well, hang on a second, is it worth going after it? Yes, it is, because really where we're positioning ourselves is at being a specialist. And being a specialist in a very narrow space where there's high demand and short supply, and we've got a brand and an engagement strategy that engages with the talent that is in demand, that will generate stronger margins, and that's effectively where we're focusing our efforts. So it doesn't matter that there's 22,000 out there, of which probably 21,950 are generalists. What matters is, you know, how strong are we in the markets in which we're chosen to operate in, and how effective and how many companies are there vying for that opportunity. And I think it's in those spaces where, you know, there are a number of different names that we could mention. There's lots of competition out there, but we think we've got a proposition backed by a brand that people listen to and engage with, that gives us a bit of a head start, and that's really where we're going to see, I think, our focus for growth. Don't know if you want to add anything to that, Mike?
Well, I think the only points that I can think of to add would be that, you know, the compliance end, you know, we are very strong in the public sector where they've always had security checks, etc., and we've always been very, very strong in that. As IR35 and other regulations move outwards into private sector, we are very well set up to be able to deliver to private sector clients in a way that other smaller businesses, or other businesses not necessarily used to it, maybe can't. And the second thing I would say is that we place a great emphasis on our engagement with the contractors themselves and the relationships we have with them. So that's attractive to clients, and that we know our contractors well. Not only does that enable us to put the right contractors into our clients, but it also enables us to ensure that contractors stay with clients where we'd like them to and where they'd like to, and stay in touch with them. And that's something we place great emphasis on. And the team that Izzy's built has the capacity and the priority to actually continue to support and engage with the contractors. And we think that's key, and that differentiates us from the kind of fire and forget that some of our competitors do, that when they place, they don't actually worry about the contractor. All they worry about is the money coming in.
Brilliant, thank you. That's the end of the submitted Q&A. Zach, is there anything else you'd like to finish with?
No, that's perfect. I think you've addressed all those questions you can from investors today. And of course, the company will review all questions submitted today and publish those responses on the Investment Company platform. Mark, just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, please could I ask for a few closing comments?
Yeah, I think it's really going back to the summary that Mike gave you. You know, we've caught the falling knife, basically. It's taken a little while. You can't just switch a light switch on and expect things to turn around in a nanosecond. It's taken us 6 to 8 months to rebuild that team. I'd like to see Izzy on stage with us, because I think she should take a lot of the credit alongside Mike in terms of what's been done so far. And unfortunately, the numbers betray that effort. But hopefully, the story we've been able to share with you today, you'll actually see exactly what's done. We have a much simpler message for the market that resonates with customers that have these challenges, and with contractors that want to progress to better opportunities. And we have a simple management structure. The buck will stop with the three of us. There is no big team. There's no ivory tower. There's no unnecessary infrastructure. We've stripped it back to the bare essentials, so we can push as much of our cost base into where it adds value and where it generates income, and that is at the front line with both sets of customers. We have a great brand here in a market that you may feel is overcrowded, but we have a special place. And that brand is really important in terms of getting you through the door, which is half the problem, especially when you're dealing with what we call passive candidates. These are people that are in demand, they're already working somewhere, and they need to be persuaded to go somewhere else. You can't do that with technology, you can't do that with a system. It needs people interaction, and that's what we've got. We've built a small but very, very capable team. And that's what we're going to leverage for growth in the future. So watch this space. It won't be overnight, but it will be steady. We intend to try and avoid any more accidents that have beset this company for the last 15 or so years. We'll do it as transparently as we can. And I want shareholders to know that we're focused on this in terms of getting their we're aligned to their success. We will continue with our efforts and hopefully demonstrate through the results that we're achieving just that. So that in a nutshell is it. I will hand back to you to finish off, Zach.
Mark, Mike, thank you for updating investors today. Can I please ask investors not to close this session, as you now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. It's only take a few minutes to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of PARITY Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.